Hello, and welcome to episode 5 of Apriem Financial Cents. This episode is a throwback to our wealth building series part 1. During the course of the presentation, our associate financial planner, Megan Schwab, gives a summary of how the economic machine works. Now, if you're not familiar with how the economic machine works, this was a 30-minute long video presentation from Ray Dalio. And I think that Megan does a fantastic job of taking 30 minutes worth of content and condensing it down into a 5-minute Cliff Notes version for us. I hope you enjoy it.
What you see on the screen is a quote from Ray Dalio. He's a very successful investor. He does a really good job of explaining how the economy works in very simple terms. This is a topic that we could talk about for hours, so we'll just be going over the very basics. And something that he says that I think is a great way of explaining it is the economy is made up of a few simple parts and a lot of simple transactions that are repeated over and over again. So going to the basics, a transaction is when a buyer exchanges money or credit with a seller for goods, services, or financial assets. So every time we buy something, we make a transaction. And this is really the building block of the economic machine. And if we can understand transactions, we can understand the whole economy. So if we go and talk about markets, an economy consists of all transactions in all its markets. So a market really just consists of all the buyers and sellers making transactions for the same thing, whether that's wheat or cars, oil, or even stocks. Those are all their own markets that work like a single gear in this bigger, well-oiled machine. So the biggest buyer and seller in a market is the government. You have the central government that collects taxes and spends money, and the central bank that controls the amount of money and credit in the economy by influencing interest rates and printing new money. And they're a very important player in the flow of credit. Credit is the most important part of the economy and probably the least understood because it's the biggest and most volatile. And for every $1 there is at least $20 of credit outstanding. And as soon as credit is created, it turns into debt, which is really important when we go into cycles in a little bit. So when a borrower receives credit, they're able to increase spending, which drives the economy. And an increased income allows for increased borrowing, which allows for increased spending, and it creates a pattern, which we call cycles. Because we borrow, we have cycles, and it's just due to human nature and the way that credit works. So every time I have more income, it may make me want to spend a little bit more. I feel comfortable extending my credit so that I can purchase something that I want. And you can see here the graph at the bottom. The straight line is the productivity line. You see a big curve, which represents the long-term debt cycle, and then those small wavy curves indicate the short-term debt cycle. So the short-term debt cycle, it goes through about every 5 to 8 years, and that's just an average. It changes. And during that short-term debt cycle, when credit is available, we see an economic expansion. So that's when the curve starts to go up. And when credit isn't available, we start to see a recession, which is when the curve starts to go down. And then that takes us into the long-term debt cycle. As long as income continues to rise, debt remains manageable and asset prices soar. But over the decades, debt increases, causing larger debt repayments, which result in reduced spending, and eventually the borrower isn't able to pay that debt back. And that's when you see that big dip and that big curve. And those long-term debt cycles typically happen every 75 to 100 years.
Okay, I think this is a good place to pause. I really like this graph that we have here and the visual that it gives us. Right, so as we look at it, you can see that x-axis is showing us time, right? And the y-axis that goes up there is representing growth or GDP. And I think that the graphic does a really good job of helping us to conceptualize credit. If you could imagine reaching out forward in time, and we're taking or borrowing that time that we spend in the future to make money, right? And that we're going to spend or use for consumption, right? And we're going to take it from the future, we're going to pull it to today, and now we're going to use it. Right? And in doing so, you can see how that helps our economy, right? There's that increase, the growth in GDP that occurs. However, at some point in time, we have to stop borrowing and we need to spend less, right? And essentially that's where that dip starts to come down. And as this happens over and over, we now have those long-term and short-term debt cycles that occur. So I hope that you've enjoyed this, this recap on how the economic machine works. If you haven't watched the full video from Ray Dalio, I suggest you hop on YouTube and just go ahead and search for it. You'll be able to find it real quick and easy. And if you haven't done so already, I'd recommend clicking that link to subscribe to our channel. And we look forward to seeing you on the next episode.